Hey guys, I'm finally happy to say that we're going to be starting our corporate finance and managerial finance videos. That is because our accounting tutorials are kind of slowly moving to our intermediate courses, and we're going to have to know some financial keywords and equations to kind of value some assets and liabilities. So I thought we'd start on corporate finance, and we begin now so that by the time we reach intermediate finance, we would know already quite a lot about corporate finance. So, to begin, when you think of the word finance, a lot of people think about personal finance. You think about your own bank, maybe Citibank or Bank of America. In Canada, of course, we have like TD, CIBC, BMO, RBC, National Bank, and you have many different investments. You have kind of savings accounts, you have checking accounts. Of course, there are those high interest savings accounts that really aren't high interest savings accounts. They really don't yield a lot. And if you have a higher risk tolerance, you might be interested in bonds or shares of a company. But of course, this is all personal finance, and it doesn't have anything to do with corporate finance, so we won't be talking about this. But we'll see some similarities with corporations where they'll make investments, or we'll look at corporations that will conduct financings that can kind of be related to maybe a personal individual making these kind of decisions. But for the main part, we will not be talking about personal finance. So let's get rid of this and bring up some of the things that are concerning to a corporation. So one thing is that they want to always remain liquid and that they are always able to pay their short-term liabilities. So right here I just have a bill, I guess you can say, paying off those liabilities, because we got to maintain our liquidity and take care of short-term obligations. So we got those down. And of course, solvency, another huge issue. We got to make sure that our assets are always greater than our liabilities. Right here we have assets that are lower than our liabilities, which means we have negative net assets, and that we are insolvent because we are getting to a point where we might have to declare bankruptcy because our assets are so low and we have so many liabilities. And net assets just means that we have negative equity, because net assets is equity. If you remember assets minus liabilities, that would equal net assets. And if you remember the equation, assets, or the accounting equation, assets minus liabilities, will equal equity. So if we have a negative part on this side, it will be negative on this side, which would be negative equity. So we always want to remain solvent and have assets that are greater than our liabilities, and we want to have residual net assets. The next thing is profitability. We want our income and earnings for a corporation to remain high. One of the most important thing of financial management is to have earnings per share maximized and to create great shareholder value and actually make sure that our stock is rising, so that our shareholders are happy and that our company is performing well. So profitability is another main topic within corporate finance. And some of the decisions that corporate finance we're going to be looking at, these are the main ones. Of course, there are other decisions we'll have to see, but these are really the important ones, which we're going to be going over three. The first is investments. So maybe if we're like a construction company, we might have to decide between making a capital purchase for maybe like a condominium. So this is something we can do with our money. We can purchase a condo, invest in that. Maybe we can get some rent and sales revenue. Maybe we'll just sell the condo to someone else so that they can create revenues from it. So that's one type of investment. We can invest in capital equipment, replace some old capital equipment so we're more productive and efficient. Or if maybe we're not a construction company, maybe we're more of a technological company or a scientific company, and we want to invest in R&D costs, because those technological companies' R&D costs are huge. If you remember, between RIM and Apple, You remember who's doing well right now? Well, it's definitely Apple, because RIM, their stock, I think, has went from, I think, $150, $140 down to right now, I think it's trading at $7 today. And that's because they fell behind innovative-wise, because they weren't basically keeping up with the best and most effective technology that consumers want, and Apple was. So RIM fell behind. If their sales aren't doing well, of course their share price will not do well either. So Apple has done really well recently in the last few years, and this is why investment decisions regarding corporate finance are so major. The next thing is, if we invest in something, we have to decide if we don't have enough money to actually cover costs of, let's say, investing in a capital project or R&D costs, we're going to have to get the money to invest somehow, and this can either be done through equity financing, which is giving up some ownership in our company and letting them have a share of the residual assets and profits through dividends. Or we can have debt financing, where we do not give up ownership, but we do have to make fixed payments to them through interest. Because if we have a $1,000 bond, that means we'll get $1,000 in cash, but we have to return that $1,000 in like a year or so, and we'll also have to pay 5% interest, which is $50 annually. And you can see the interest will really add up if we issue thousands of bonds, which will equal millions of dollars of cash for those investments. So we can go with debt, we can go with equity. Those are the two types of financing. And also there is hybrid instruments like preferred shares and convertible bonds. There's many different hybrid instruments, and we're not going to go over these too much in the near future, but you should mainly worry about equity and debt financing, because those are really two major parts of where we're going to be deciding how to raise money for our projects and investments. And of course, if you ever forget the word bonds, and you can't think of that instrument's name, you can think about this guy, and he'll always remind you. So let's go to the third topic of corporate finance, which is really major, and that is the management of working capital. Working capital is current assets and current liabilities, which I've said over here. And it has to do with collecting receivables, which are those accounts receivables, so money coming into us, collecting cash, really converting those receivables into cash, I should say. Paying suppliers, which is us giving our cash away to essentially suppliers for inventory or other purchases that we've made, because if we don't pay cash on time, interest will accumulate for us not paying on time. And there's many other working capital assets and liabilities as well, like inventory and managing prepaid expenses and so on. So it's not just looking at cash receivables and accounts payable. There are other current assets and current liabilities. And of course, we always need to worry about how much cash to keep on hand, because we don't want to end up in a cash crunch. A cash crunch is not great at all. That means we have kind of run out of money for short-term obligations, and we might have to quickly run to the bank to get a loan so that we'll be able to cover our short-term obligations and be able to pay our suppliers or our creditors, and that might give us a higher interest rate, which leads to greater interest costs. So you always want to have cash on hand for the next short-term foreseeable future. And finally, I should say good financial management, of course, is important to a company, but also the business model, the product, how you treat your customers. Those are all very important to the business. But companies that have done well with corporate finance and managing decisions like investments and financing and capital or working capital are companies that are absolutely huge. Like one I should say everyone knows is Apple. Apple is the most valuable company in the world. It has a value of $595 billion. Market cap is essentially market capitalization, which means the value of all of these current shares, or the value of the firm at the moment. So it's worth $595 billion. Of course, market cap you can get by multiplying the number of shares by the stock price. So if you take number of shares right there, multiply it by the price, you will see that it equals that. So Apple, one very good example of financial management. Another, of course, ExxonMobil, which is an oil company, used to be the biggest in the world for market capitalization, but they fell behind Apple recently because Apple is growing exponentially to the sky. Not sure if, well, eventually it might fall. We'll see what happens. There are a lot of different debates on that. But ExxonMobil, another huge company, $422 billion. And of course, again, that market capitalization you can get by multiplying shares by the price. So those are two absolutely huge companies, and we're going to be looking at all investment decisions in financing and working capital and many other decisions for corporate finance over all these videos. So a lot of things we're going to be covering in the near future through all the many videos you'll see are things like capital budgeting, what to do with cash and cash flows, and cash management. We'll be looking at essentially the time value of money. You might have heard about that in recent lectures, maybe in school, present valuing and future valuing, receivables and different assets. We'll also be looking at capital investment decisions, looking at net present value, IRR, payback period. You might not know these terms yet, but you will, I assure you. We'll also be looking at other things like return versus risk, because of course the more return is usually associated with more risk, less return usually associated with less risk. We'll also be looking at things like bond valuation. So there's many different topics we'll be covering, and you'll just have to watch those videos to see all of the different things that I'm talking about here. So I'm going to end it because I think we're kind of going over our budgeted time. I usually try and keep it under 10 minutes, so make sure to check out the next few tutorials. I think we'll be talking about the corporation and financial markets in the next tutorial. Thanks for watching, and I'll see you guys in the next one. I'm sure you guys have questions regarding accounting topics or our videos, so make sure to tweet us at #iNinjaNotes, like us on Facebook to receive updates, or to share any quick anecdotes about how our videos might have helped. And like always, thanks for watching us on YouTube.